Are you doing everything you can to set yourself up for success in the future? I'm going to share with you a video. I recorded it about a month ago, but I'm sharing it with you today. And I'm talking about the number one thing when I talk to my clients that are at retirement age, they wish they would have known when they were younger. Stay tuned because their lessons learned are going to help you save and set yourself up for more success in retirement. Hi, I'm Julie Merrill. I'm a CPA and I thrive on helping individuals and business owners grow their wealth while saving taxes along the way. What that tip is, and that lesson learned is they all wish they would have put money into a Roth retirement account early on and grown that money over time so that they're sitting on a retirement account that's large in a Roth and not in a traditional IRA. So let's talk a little bit about the difference and why, the baby boomers, if you will, only put money into that. I mean, Roth wasn't a strategy going back. When they went into a W-2 employment situation, if there was a retirement plan, it went into a pre-tax account. So they get a tax break today for putting money into the account, and then it grows over time. And when they take money out of it, it's taxed. The Roth is the opposite. So we put money into the account. We don't get a tax break today, but it grows tax-free over time. And when we're retirement age, when we take money out, there's no tax. There's also no RMD requirement. So unlike the traditional retirement accounts, when you reach a retirement age, the IRS starts mandating that you draw, and not only draw something, you draw a certain percentage based on their lifetime table every single year. And because it's pre-tax money, you're taxed on it every single year. So it provides this taxability into retirement age that Roths don't. And we're not only taxed on the money they contributed over the last 30, 40 years, but all the gains on it. Now, the Roth, we don't get the tax break going in, but all the gains on it are tax-free, along with the contributions when we take them out. And if you put money into a Roth, you can take out your contributions that you put in at any time tax-free without penalty. So game changer when it comes to maybe looking at the younger workers, maybe even our kids that are under 18 working for us in our business, contributing to those Roth accounts and using it as a quasi savings account that can earn money tax-free in the meantime. So let's just talk about hiring our kids, because this is a topic that comes up all the time. I have a whole ebook on it, and I have a link below to the ebook on how to hire your kids. As soon as your kids start having earned income, so W-2 employment income, whether that's through Panera or your home, family business, they now have the requirements enabled for them to contribute directly to a Roth IRA. If they're under 18, you can open a custodian Roth. If they're over 18, they can open their own Roth, and they can contribute up to the annual limit or up to their earned income. So if they only earn $5,000, they can only contribute up to $5,000. If they earn $15,000, they can maybe contribute up to $7,000 if that's the annual limit the time you're watching this video. So getting our kids to contribute. Now, if they put the money directly in because they're allowed to, because Roth do have income limits. So a lot of times when we're making money, we're over the limits. But our kids, on the other end, typically aren't when they're just starting in the workforce or they have some side income. Allow them to build that. And if they later want to use that money, the contributions part, to take it out to pay for college, buy their first home, start their first business, they can draw on that as long as they don't draw on the earnings and just their contributions, tax-free without penalty. So it becomes this whole vehicle during your, earning phase where you can use a kind of a tax-free savings vehicle. But if you don't touch it and it just grows over time, then we have this nice little nest egg when we get to retirement age that we can draw on, and there's no tax implications for drawing on that account. There's a whole other strategy that we talk about with clients about using their Roths while they're not retirement age to invest in potential future retirement homes or rental real estate. And that happens through a self-directed custodian. It's not something that's facilitated if you have an account with a Schwab or a Vanguard or Fidelity. You have to use a special custodian, but it's absolutely available to you to do. And it becomes this magical investment strategy and tax saving strategy when you're using your Roth because it's post-tax money. So the number one tip I get is why they wish they could tell themselves, younger selves, is they wish they had put more money into a Roth versus a pre-tax retirement account for years over time. I do want to talk about one misconception with the Roth, because you can't directly contribute if your income is over the limit. Now, there's the backdoor Roth strategy. I'm not going to that into this video, but there's another strategy where you can still contribute directly into a Roth account and your income doesn't play into the fact. And that is if you are employed. If you have a W-2 salary, whether you're working for an employer or you have your own business, if you have an S corporation and you have a solo 401k, or you have an owner 401k or a business 401k for you and your employees, you can add a Roth bucket underneath that retirement plan. Whether it's, or the employer, if you work for someone else, might have a Roth bucket underneath that employer plan. As an employee, you can contribute up to the annual limit. That might be $23,000 this year, or $30,500 if you're more than 50, given current year IRS limits, out of your paycheck. And you can possibly, if it's set up in this way, the plan allows it, we have a Roth bucket, you can put that money directly into a Roth. You could be putting, if you're over 50, over $30,000 a year into your Roth account through your paycheck, and your income limits, there's no limits. Doesn't matter. You can be making 100,000, you can be making $1 million, and it's still, you're allowed to do this. I'm Julie Merrill, and I'll see you next time.